Hey Peter, Stuart here. Thanks for your question. It's a really good one, and sorry for the late reply. I've been on leave, thankfully. It's a good question. It really depends on whether in terms of investing in your home and being single point sensitive in your home, because I've spoken a lot about the benefits of really upgrading your home and benefiting from the tax-free capital growth. Your question about, whether if you do go too hard with respect to that in terms of borrowing for non-deductible purposes for your home loan, what is the impact of restricting your ability to invest in other assets? And I said it's a really good question. You mentioned that your super balances are quite healthy. It's something I might write about in the future, but it's really surprising that it takes a long time for us to get to $500,000 in super, but typically go from 500,000 to 1 million. It's a lot quicker, maybe 7, 8, 9 years, depending on returns, of course, but just generally speaking, that's what I've observed. And the same again to go from 500,000 to 2 million. So if you've got healthy super in your 40s, then it's likely your super balance by the time you get to 60 is going to be very healthy, assuming it's well invested, of course, in a good fund that's got low fees. So in that case, if you put all your eggs in one basket in terms of really upgrade your home, probably not such a big deal, assuming if you're comfortable that your super balance will be enough to fund retirement. However, if you don't feel that's the case, or you'd like not to be solely reliant on that, then yes, you need to consider your ability to invest in other assets. Now, if you're in your mid 40s, you might say, look, we'll take on this higher home loan. We'll concentrate on reducing debt for the next, say, 5 to 7 years. So long as we can see in that time, in say 7 years' time, if we then have further capacity to be able to borrow for investing purposes, then that's okay. So you don't necessarily need to do the two at the same time. You might decide, let's focus on this home upgrade now, with the idea that, in our early 50s, we'll go and buy an investment property to sort of supplement super. Alternatively, if you are confident that your super is going to be enough to fund retirement, then you don't really need to worry about it. I tried to make the point in these blogs that, investing in your home has a couple of benefits. Of course, there's some lifestyle benefits of living in a really good home that suits your circumstances, that's large enough in a great location. And then secondly, there's the financial benefits of that tax-free capital growth. So I guess if it all doesn't work out, worst case scenario is you downsize. If you've pushed the envelope and bought something a lot better than what you otherwise would have today, well, in 15 years, you can always downsize. If you feel like, well, super hasn't actually worked out as I'd hoped, you can always downsize and pull out some equity at that stage. Now, you need to make friends with potentially downsizing in the future. But as I said, if you're pushing the envelope and buying a larger or better home in a better location than you otherwise would have, that's the strategy. Well, then that's a potential mitigant in terms of, super not working out. Very difficult to give you some definitive advice on this, but they're the sorts of things that I'd be thinking about or considering. If you said in your description you had very low super balances, well, then I would be concerned and say, yes, absolutely don't overborrow, leave some room so that you can invest in other assets. Anyway, Peter, I hope that helps. I'm glad you're enjoying the videos in the channel. Cheers.